And good morning once again, options traders. Well, I came up with a little idea here for 2024, and a lot of times I will pick up books that I know are a little on the hypey side, but I do it just to find out some of the bad ideas that these people are suggesting. And I happened to bump into one. I'm not going to mention the title of the book or the author, but let's just say this person has been a fairly big name in the industry, used to run a newsletter, was apparently a professor at a college, somebody who should know better. But this book is chock full of bad ideas. It's a treasure trove. So I thought, yeah, most of the time you want to channel people into what to do, but sometimes it helps to understand what not to do. And so I'm just going to sprinkle these in throughout the year in no particular order. I'm just going to call them idiotic ideas. So here's the first one on the list, and that is to take quick profits. You'll hear this from a lot of people, but why is it such a bad idea? Let's go find out. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is greatly appreciated. So here we go. Here is a direct quote from the book. It says that when you are trading options, time is your enemy. You are usually given only one chance to take a profit or cut a loss. If you are not quick enough, you are dead. There are no second chances. Okay, so what does this tell the new trader? As soon as you get any hint of a profit, that you need to take it. You might only have one chance. So if you buy this option for 5, what are we going to define as a profit? 50 cents, 30 cents? Where do we draw the line? See, that's never stated. It just says you're only given one chance to take a profit. So new traders are led to believe that as soon as you get any kind of a profit, you got to take it. And yeah, I know there's the expression, you can't go broke taking a profit, which is not true. We have to understand the expected value. So anyway, here's the quote. And so let's find out why this is such bad advice. First of all, this is the classic picking up nickels in front of bulldozers routine. That's what this is called when people are advised to take relatively high risk strategies and just collect a few pennies along the way. It can give you a false sense of confidence because you'll think, oh, I've got a profit, or I've got 10 out of 10 trades and I'm profitable on them. It gives you this false sense of security. But here's why it's not going to work in the long run. Let's take a look at a bell curve. Now remember, stock prices, at least in the short run, are certainly going to follow, roughly speaking, a bell curve. So here is the current stock price in the center. So you've got about a 50-50 shot for the stock to be on the right-hand side or on the left-hand side. So let's just say if this is our strike, you've got about a 50-50 shot for it to be in the money, assuming it's an at-the-money strike. But it gets worse than that. Because you pay a premium for a long option, let's say if you pay $5 for this $100 call, you need the stock to rise to 105 just to break even. So this is not necessarily the profit line, it's actually shifted to the right. So take a look at what happens to your distribution of risk and reward. Everything over to the left is a loser, and keep in mind that the stock price is right here. So we've got this gap right here in between that we need some movement just to break even. I've talked about that before with direction, magnitude, and speed. The options trading game is not just about up or down like it is with stock. So take a look at the area that we need to be in for profit. So you can see that right off the bat, the odds are stacked against you. The probability of any profit on any long option has to be less than 50%. But now, what happens if you take this advice of taking very quick profits, the first sign of profit? What you're saying is, I'm going to expose my position to all of these potential losses over here to the left in red, and I'm going to survive by taking these relatively small potential gains. But I'm never going to let the gains get too big because I'm going to clip them. I'm going to close these options at the first sign of profit. So now you can see what happens to your risk and reward. You're not ever allowing for those few times that the stock really takes off to profit from it, because the advice is close it at the first sign of profits. Now he also said you might not get a second chance to close out a loss or to close out a position for a small loss. But see, that's not really true either because a lot of times the stock price will head below the strike, let's say like this, but end up over here on the profitable side. But if you close those for a loss at the first sign of loss, all you're going to do is to end up with a large number of losing trades, and there will be some times that that stock is going to just shoot straight out here to the left. And it's going to leave you with 100% loss, whether you want it or not. And so it's really just an absolutely idiotic idea to take this type of advice. You are intentionally limiting your gains, and you may be able to limit losses, which he kind of hints at, but there are no guarantees. You can't stop a stock from gapping down. The net result is that you are creating greater probabilities for losses, and you are also creating smaller gains for the few times that you win. Now, also, he suggests at a different part in the book that it's imperative to use stop orders. And that's another way to greatly limit these losses. Well, that's just false. Stop orders will not prevent losses. So to make that point, here's an article that came out recently. Boeing shares tumble 8% after FAA grounds dozens of 737 MAX 9s for urgent safety inspections. This came out before the opening bell. You can see right here, this is at 4:13 in the morning. So the stock is already trading down 8%. Off the opening bell, what's your stop order going to do? It's going to get triggered and you're going to close at the maximum loss, most likely, unless you're using a deep in the money option. But the point is that the stop order doesn't prevent it. If you use a stop limit order, yeah, you still might hold the position, but chances are it will be a loser at expiration. So again, you have to understand that this whole idea, and this author is not the only person out there touting this. Lots of people feel that the best way to approach the options market is to take very quick profits. But it's only going to guarantee you losses in the long run. So what's a better idea? Well, a better idea is, yes, it's true that time may be an enemy of short-term option buyers, which is what this person said. But time is also your best asset for the long term. There's a long-term upward drift to stock prices. So the better idea is to hedge the downside, define your risk, have a goal, let your profits run, and that's where hedging, rolling, and morphing become invaluable. You've got to be willing and knowledgeable on how to hang on to those profits, hedge the downside, get some money off the table, but let those profits run. So the main thing to take from this, don't rely on the idiotic idea of closing positions at the first sign of profit. That is a guaranteed road to losses. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.